ما هو جت بسطرة.
Okay, class, good evening. So I'm going to reset this class in a way that you won't be able to unmute yourself because there's this person in class. His background noise is something else. So when you want to ask a question, you simply raise up your hand, then I will unmute you so that you can ask, so that people will not disrupt our very important class tonight. Okay. So good evening. What we have in front of us today is a 20% part of our syllabus regarding analysis and interpretation of financial statements. The approach for tonight would be, I would just run through the ratios, run through it. I won't spend a lot of time on it, like I would have usually done, because the approach we're going to use tonight, we're going to focus, it will be more of past questions approach. And that's on the assumption that we might be familiar with most of these ratios now. So I would majorly focus on how do you then answer questions in the exam. That would be our focus for tonight. So, analysis and interpretation of financial statement. We have learned a lot of accounting standards. You have learned series of principles regarding how to prepare consolidated financial statements. All of these we have been teaching you all these weeks or months. They are geared towards preparation of financial statements. Tonight, we'll look at how do we analyze these financial statements. I would be looking at two major tools for analyzing financial statements. I'm going to start with ratios. I will quickly run through it within 20 minutes. I won't spend more than that, or 15 ratios. Then I would also briefly look at cash flow statement. So cash flow statement is also a tool for analyzing and interpreting financial statement. So over the last 2 years or more, I can have asked question on analysis and interpretation of financial statements, diet in, diet out, over the last 2 years. We expect them to continue this diet as well. You might most likely find it in your exam for 20 marks. And we would see, when we look at past questions, we will see how they have been asking it so far. Now, let me start with the part of ratios. Let me start with ratios. The first thing is, why even ratios in the first place? Why are we using ratio? Because when we want to analyze financial statements, it shouldn't be something difficult that we will now need tools, some set of tools to do this analysis. Because I can just compare revenue of company A and revenue of company B. I look at which one is higher, then I make my decision. Or I look at profit of company A along with profit of company B. I look at which is higher and make my decision. Or I look at their assets to have an understanding of their relative size, as well as their liability to have an understanding of their relative exposures. But you agree with me that that might be misleading when you want to focus on absolute analysis to understand the share profitability and liquidity of a company. Because a company that is making a profit of 10,000 naira might not be as good as a company that is just making 6,000 naira. It might not, even though it's making 10,000, it might not be as strong or as profitable as another company making 6,000. Because that company that is making 6,000, maybe the capital it was able to use to generate that 6,000 was just 3,000 naira. While the one that made 10,000 had a capital of 12,000 naira to be able to make 10,000. But the one that had 3,000 made a revenue of 6,000. The one that had 3,000 capital and made a revenue of 6,000, meaning that it turned around that capital more than almost 200%, 2 times. But the one that had 12,000 and made a revenue of just 10,000, it was unable to turn around up to 1 time. That is the beauty of ratios. Beyond just looking at the absolute values of line items in the financial statement to judge companies for their relative profitability and liquidity, we need to look at the underlying financial resources that were used to generate most of these absolute figures. And that is why ratio is important. So what ratio will do for us is that it can assist us to compare figures, one figure in the financial statement against another. when we compare similar figures, we will be able to identify and have an indication of the strength and weaknesses of these companies. There are 5 categories of ratios which I believe you are all exposed to: profitability ratios, efficiency ratios, liquidity ratios, debtor solvency ratios, and investors ratio. For the profitability ratios, the popular ones are the return on capital employed, the returns on equity, the gross profit margin, and the asset turnover. Most of you should know that the return on capital employed measures the amount of profits that an entity is able to generate from its available financial resources or capital, which is also very similar to returns on equity. The only difference is that returns on equity focuses on the return or profit an entity is able to generate from its equity capital. The return it was able to generate from its equity capital, but which is why it is profit after tax over equity. But when you see returns on capital employed, this looks beyond equity. It looks at the profit an entity generates from its entire capital structure, meaning a combination of its equity capital and debt capital. So it didn't restrict the capital employed. Also is profit margin, which is profit over sales, that looks at the amount of profit an entity makes on every €1 of sales. Every businessman knows profit margin. They know it because when you are a trader and you go to the market to buy goods that you want to resell, immediately you buy, you're already thinking how much you want to sell. You're already thinking of your selling price. You're already thinking of the gross profit you're going to make. If you express that gross profit as a percentage of sales, that's your gross profit margin. In your SFM, in your performance management, they will tell you that when you express that same profit as a percentage of your cost, you say that's markup, but that's not our focus here. Our focus is on your sales, right? Because we are focusing on the gross profit. So we express that profit as a percentage of sales. There's asset turnover, which looks at the efficiency in converting assets to sales. How well or how many times an entity is able to generate sales from its assets, asset turnover. Usually it's sales over capital employed. And in your exam, you find out that when I saw a few questions with you, I told you that when we solve past questions today, you see that the capital employed you use under this asset turnover will simply be the capital employed you would have used under your C. It's always be the same. Just use the same thing. The capital employed you used for your asset turnover must be exactly the same one you used for your sales over capital employed. Okay. And you also need to know that your asset turnover and your profit margin are a secondary ratio to ROCE, because by the time you multiply profit margin by your asset turnover, it gives you your ROCE, because profit margin is profit over sales. Asset turnover is sales over capital employed. If sales cancels out sales cancels out sales, we are back to ROCE. So it's a secondary ratio for ROCE. The next category of ratio is working capital ratios. The emphasis in your exam would be the first one, which is working capital efficiency ratios. So you'll find the examiner calling these efficiency ratios. So hardly would you find them asking you about turnover ratios, but I'll certainly show you. Now, the efficiency ratios are three. We have the trade receivables collection period. We have the inventory collected. We have the inventory turnover period and the trade payables payment period. You see, this trade receivable collection period can be called trade payables, trade receivables in days, or debtors in days, or they can simply call it collection period. It simply measures the number of days it takes an entity to collect its money from its debtors or customers. The earlier, the better. Because you're able to collect your money early enough from your customers, it means you have sufficient cash flow to pay your suppliers. It means you are efficient as a company. It's calculated as sales all upon your trade receivables. So it's calculated as trade receivables all upon your credit sales, usually. So trade receivables all upon your credit sales. While the inventory turnover period measures the number of days it takes an entity to sell its inventory, to clear up its inventory, and also is measured as inventory all upon cost of sales. I mean, you find this on text. They will say that inventory is average inventory. I will employ you to use closing inventory in the exam. You don't have time because they will want you to calculate like 10 ratios under 12 minutes or 13 minutes. And you will come and analyze again. That's maybe another 10 or 14 marks. And these things takes time. So when you have inventory turnover, use your closing inventory all over cost of sales. Even this trade payables payment period that measures the number of days it takes you to pay your supplier. Cost is your trade payables all upon your credit purchases. But in 99% of the case, you will not find your credit purchases given to you. What you have is your cost of sales. Please use the cost of sales. The differences are not much. Your ratio will still give you what it should give. So trade payables over cost of sales will fly. Even though the formula you would write for them is trade payables over credit purchases. And for this one, for the trade receivable collection period, of course, the shorter the better. For the inventory turnover period, the shorter the better. But for the trade payables payment period, it now depends. I mean, some people will argue that the longer the better. That if you delay payment to your trade payables, it means that you'll be able to invest that money somewhere else and make some returns, right? Some people argue that. I always disagree with that argument because why would you want to be using your supplier's money to make money? It's your supplier. This guy gave you goods on credit. He gave you capital. When you have sold those goods, pay him his money now. You want to be using it. It's never a good argument. It's never a good argument. So if you have the opinion that an elongated trade payables period is good, then you should be able to argue, Deborah, what are you doing? So I just intentionally undid what I did. I wanted to disable unmuting, but Funsho, if you don't stop this thing you're doing, I would remove you from this class. Do you have serious background noise? Stop unmuting yourself. Okay. As I was saying, if you want to argue along the line that, okay, the longer the trade payables payment period, the better, You should argue from the standpoint of that, okay, this company is a credit-worthy company, and that is why his supplier has given him an elongated credit period. Argue in that line. Don't argue in the line of, yes, it's good to have an elongated credit period because you can use his money to invest. Then later you get returns, then right? For us, is not so much of a good argument because a company that pays its suppliers early is good because the supplier will be willing to even extend you further credit. They want to extend you, they want to do more businesses with you. It means you're credit worthy, right? And it has a long run and short run advantage for a business. So that's that. Also, you see, when you mix trade receivables, inventory turnover period, and your trade payables period, when you combine them together by adding trade receivables collection period to inventory turnover period and removing your trade payables payment period, it gives you an operating cycle, which is the period between when you start a business and when you end it. When I say a business, I mean a transaction, a singular transaction. The period or the number of days it takes you to start and finish a transaction. Of course, the shorter, the better. So when you have a short operating cycle, it means you're an efficient business, which is very good. And additionally, when you see a company having an elongated operating cycle, where its operating cycle is so long, it's not good. It's not good. So what do you think that will indicate, if I may ask? You can easily unmute yourself and say something. A company that is having an elongated operating cycle, what would that show? What does it show? What does it indicate?
The capital employed is too much.
Can you explain further?
Okay, so it means that okay, so it will mean that the inventory turnover period is high, right? It also means that so if the inventory turnover period is high, it means that the company is actually overproducing. And so overproducing would mean that you're actually investing too much capital, right? So it means you're producing more than you can actually sell. This could also mean that the trade receivables turnover period is also high, which means that maybe the company is actually like maybe over trading or so, right? So yeah, I'm coming from the angle of trade receivables turnover period and inventory turnover period. Yeah. So maybe the company is actually inputting too much capital into the business, producing so much inventory that they're not even able to sell. Or maybe they are selling and they're not able to recoup the trade receivables.
Good ideas. Good idea. Perfectly correct. You're correct. I mean, you have painted a scenario of overcapitalization and over trading. That's what they indicate, which you have explained to us very well. So, for like you have said, when a company is overcapitalized, you see all its elements of working capital are very high, but they are not efficient enough to convert most of them to cash. They cannot end that transaction. They can't end it. They can't sell. So almost everything is heavy. Everything is high. Trade payables high, inventory high, trade receivable high. The same thing has overtrading too. Overtrading is when an entity is doing more than what its resources can accommodate. Overtrading is even worse because overtrading can lead to liquidation. Because when a company is overtrading, it's usually indicated by this. Let me show you. It's usually indicated by, oh, it's not here. Okay, yeah, I have it here. So it's usually indicated by a company, for example, that has, let's say, 20 million naira capital, and this 20 million can only do, let's say, 10,000 units of whatever it sells. But he went ahead and do 100,000. He actually did 100,000. But the capital he has can only do 10,000. So for him to have achieved this 100,000, a lot of things will have happened. You will have borrowed so much. His bank balance will be negative. You see increase in PP. You will have invested so much in fixed assets just to be able to produce most of these items. You now find out that he will sell because he will be desperate to sell, but he will still have a lot of inventories as long as a lot of receivables, because in his desperation to sell, he will be given too much favorable trade credits that those people will not pay. And because he doesn't have sufficient resources, he will have been buying from its suppliers on credit. And when you look at his finance cost to be so high because of the sharp increase in borrowings and because of the sharp increase in revenue that is not backed up by cash, it will trickle down to profits, which will make him paying a very high tax. So everything is just pointing not, but yeah, is not strong enough because there's no cash, there's no liquidity. So this possible solution to most of these issues that this guy has, one, those people he has borrowed money from, he can restructure the loans, right? Probably they will give him favorable, elongated period, reduced interest rates, and all of that. Could probably sell some of these assets, those ones that are idle. Those receivables, you can get a factor to help him recover the money. Payables, can negotiate with suppliers, and ultimately he should find a way to inject capital because he needs money. He needs serious cash flow. He's in overdraft already. He has a negative cash position, which is very bad for any business. And when you compute working capital for this guy, which is current asset minus current liability, it will be negative. It should be serious negative. Okay, so that is that. The one I said you would mostly not find in your exam, those are turnover ratios. It's just the reciprocal of the efficiency ratios. Like we have trade receivable turnover, which is credit sales over trade receivable. You see that is the reciprocal of trade receivable turnover period, which is trade receivable over credit sales multiplied by 365 days. But this one is the reverse of that. And why it's not so popular is that this thing doesn't really indicate so much. I mean, what would trade receivable turnover possibly means? Is it how many times your receivables paid before they finish paying or what? So hardly would you find it in your exam. The one I've seen I can ask you is inventory turnover, which is cost of sales over inventory. This one can indicate how many times you're able to sell before you cleared all items in inventory. How many times? So, I mean, inventory turnover would mean that how many times you're able to clear your factory or your warehouse in a year. It could indicate a lot of things. I mean, it could indicate that, okay, you're a fast-selling company like that. So I've seen it one or twice in your past questions. Then there's trade payables turnover. Doesn't really also indicate much, which is the reciprocal of trade payables turnover period. Another one is liquidity ratios. There are like 3 of them. There's current ratio, quick ratio, and there's cash flow ratio or cash ratio. Let me call it cash ratio. So the current ratio looks at whether a company has sufficient short-term assets or current assets to settle current liabilities. So it's current asset over current liabilities. I mean, it's expected that at a minimum, it should be the current asset should cover the liabilities at least twice. That shows that, okay, you're liquid, but it could be more because if your current ratio is 3:1 and you are celebrating because you believe that, okay, it has covered it more than twice, but your competitors or the industry average in the industry you're operating, people are doing 6:1. I mean, you're not doing well. So ultimately, it goes a long way when you're able to do a comparison to previous year or to some other entities. Another one is quick ratio. And quick ratio is similar to current ratio, just that this focuses more on highly short-term current assets or focuses on liquid asset itself. And it does this by removing inventory from our current assets so that we are left with the assets we believe is liquid. When we put that on our current liabilities, that would give us a sense of how ready we are to settle our short-term liabilities or obligations. So, I mean, it's popularly expressed that a ratio of 1:1 is okay, but again, it's more of when you're able to compare it with industry average, or when you're able to compare it with your performance or your ratio in the previous year, that's a more reliable measure to say that, okay, you're doing well or you're doing bad, not focusing on maybe it's 1:1 or 2:1, that is fine, right? And there is another one which is not here, that's cash ratio. That cash ratio, that one even goes further by looking at, okay, your cash and cash equivalents. Let's put it on your current liabilities. Let's put your cash and cash equivalent on your current liabilities, and let's see whether you have sufficient cash to settle short-term liabilities. And that's the best, because it means that if that ratio is good enough, if it's high enough, it shows that if any creditor should come today, you can just ask the creditor, okay, how much am I owing you? Give me your account number, and you transfer almost immediately. It's the best. Okay, so those are liquidity ratios. And of course, a high liquidity ratio indicates that this company is in a good cash flow position, which is good. Then there's debt ratio. This one focuses on the ability of a company to continue to operate as a going concern. And why are we looking at it as the ability to continue to operate as a going concern? Because this ratio will help you establish how much debt you have in your capital structure. How much debt you have in your capital structure. That's what this ratio would actually let you see. And of course, most of you would know that when you have serious debt or so much debt in your capital structure, there are risks you're exposed to, particularly financial risk. And financial risk is the risk that you might not be able to pay your interests as at when due, which might lead to liquidation of your company. It's a financial risk. You might say, no problem, I'll have the cash flows when it is due. And these debts we are talking about are debts that they are encumbered on some of your assets, are debts that You have to pay them fixed interest every year, and you must not fail because they are contractual. So there is a risk that what if you don't have cash flows at that time? They can liquidate your business. They can take over some of your assets. That's financial risk. Another risk is that you might not be able to pay sufficient dividend to the ordinary shareholders if finance cost happens to be too high. It's a risk because when you're not returning money to your shareholders, most of them will want to sell your shares. And when they sell your shares, your share price will fall. So debt ratio, gearing ratio, interest cover, and cash flow ratios, all of them measures that. Why debt ratio looks at total debt on your total assets, which is the proportion of your asset that is financed with debt. Gearing ratio, which is also called leverage ratio, looks at the proportion of debt in your capital structure, which is debt over debt plus equity. And for gearing ratio, the focus is always on interest-bearing debts, meaning debts that you pay interest on. So you don't just take all debts, you don't just take all non-current liabilities. You take only the one that has fixed interest attached to it. And when you're using interest or you're using debt over debt plus equity, when your ratio is above 50%, it definitely shows that this company is highly geared, which is bad because it shows that it shows the level of financial risk you're exposed to as an entity. And when you want to know whether highly geared is bad or good for you, then look into your interest cover, because interest cover will show you the strength of your profits, particularly the PBIT, to actually cover your interest. It will show the ability of your profit before interest and tax to cover your interest. So, of course, the many times the better. Some people will say 3 times, some people will say 6 times. Of course, the higher the better. If you can cover it as many times as possible, then that's better for the company. And the one of cash flow ratio. So cash flow ratio will look at your cash flow on your total debt. It will put your cash flow on your total debt. So, and what this is looking at is that let's even see if you have the sufficient cash flow to pay this long-term debt. Let's even see it. And this cash flow you're talking about is not your cash balance, so because that cash balance might just be the money you just borrowed also. So it's always the cash flow from operating activities, the cash flow you generated from your operations. That is the one we look at, not your cash in hand or your cash at bank. So cash ratio is just for us to see if this company is strong, right? If this company is stable, and the higher this ratio, the better, right? For cash flow ratio. So the one that the lower might be the better is this debt and gearing ratio. But the interest cover and cash flow ratio, I mean, the higher the better for them. Okay, remember I'm just running through these ratios for us. Now, there is investors ratios. And these ratios are popular for companies that are quoted and for shareholders. And in the exam, they will simply ask you investors ratio if they want you to compute any of these ratios. So the first one is dividend per share, which is total dividend over number of ordinary shares, right? And that's dividend per share. And there is dividend yield. Dividend yield. So dividend yield is usually dividend per share over market price. You will call it dividend per share over market price per share, which measures the actual return to shareholders. It measures the actual return to shareholders. Dividend yield is a better measure than dividend per share, because dividend per share, we just look at the nominal dividend a company gives to its shareholders. I mean, when you see company A getting a dividend per share or paying a dividend per share of, say, 4 naira, and company B is doing, say, 2 naira. Obviously, looking at that nominal or absolute value, you will say the guy paying 4 naira is better. Not until you put how much they bought those shares below them. Then you will see that the one that is paying 2 naira might be better. Because if the one that is paying 4 naira, you bought that shares for 2 naira, that means it has returned your money like twice. But the one that is giving you, what am I saying? Let's say the one that gave you 4 naira, you bought those shares for 4 naira. But the one that is giving you 2 naira, you bought those shares for 1 naira. It's better. The one that you invested 1 naira per share and is giving you 2 naira per share, that is better. And the same goes to earnings per share. You know, earnings per share is profit attributable to ordinary shares divided by weighted average number of ordinary shares. Right? It's a good measure of returns to shareholder. But a better measure is even earnings yield. When you put market price below that earnings, you will see the effective returns to shareholders. And there's dividend cover, which is how many times your earnings can pay your dividend. You see them writing this as EPS over DPS, dividend cover. And there's dividend payout ratio, which is proportion of your earnings that is paid out as dividend, which is the reciprocal of dividend cover, DPS over EPS. There's dividend retention ratio, which is proportion of your earnings that is retained, which is usually retained earnings over your profit for the year, or it could be 1 minus DPS all upon EPS, like that, dividend payout ratio. So those are investors' ratios. And the last one here is price earnings ratio. Price earnings ratio. Is there anyone here that can interpret price earning ratio before I go? Is anybody? Can you try? Price earnings ratio. Can anybody interpret price earning ratio? Nobody. So price earning ratio usually looks at the confidence of the market, of the public in a company. And from the name, we get the formula price, which is market price, earnings over earnings. So a company that has a high price earning ratio, it shows that that company will grow. It shows that that company might not be paying so much earnings now, but it will pay in the future. I mean, these are indicative of companies like, let's say Tesla, for example. You see, when you look at the valuation of Tesla, it is worth much more than Toyota and even Benz. Both of them combined is worth more than them. Even though those ones are selling more cars in terms of volume, they're doing a lot of money in terms of revenue, and they are doing a lot of returns to their shareholders. But market still values Tesla more than those automakers. Why? Because they believe that Tesla will still go beyond them, because they looked at the business model of Tesla and they say, okay, this guy has found a way of making continuous money from cars. Because when you have a Tesla, you know, just it's beyond the one-off payment you pay for the car. There are subscription services you key into, depending on the kind of software that will be installed in the car, the kind of packages you want, and all of that. So he has found a way to make money continuously through subscription services and other services that automaker offers. So for even looking at this ratio, for a company to have high PE ratio, it means that this denominator must be small and market price must be relatively high for you to have a high PE ratio. It means your earnings is small and market price is huge. That's counterintuitive. That's not how it should work. The a priori expectation, or what we expect, is that when your earnings is small, your market capitalization should be small. But now it's working against logic. And that's what PE ratio does. When you look at a company having a high PE ratio, it means that there is a strong market confidence behind. Okay. Now, there are other areas that you would need to read up, like limitations of ratio analysis. All these ratios I'm talking about, they have limitations. Just look at this. I've seen I can ask you to mention 3 or 2 of them. And also, I have a limitation of financial statements generally, talking about the historical cost, seasonal trading, creative accounting, and all of that. Okay, so very quickly, let me talk about statement of cash flows as a tool for analyzing financial statements. Most of you already know that you prepare your statement of cash flows from P&L and statement of financial position. So when you look at statement of cash flows of a company, it shows a lot about that entity. It shows a lot because majorly their cash position is just one of it. It shows whether this company can even continue to operate in business. It shows how investment savvy is this company. It even show that the profits that they are presenting in their P&L does it even have quality. It shows statement of cash flow is a powerful analytical tool that if you want to know whether a company is doing well or not, don't even go to P&L or balance sheet. Go to their statement of cash flows. Because by looking at their operating activities alone, firstly, just look at the net cash flows from operations. Go and compare with the profit for the year in P&L. If net cash flows from operation is let's say 10 naira, and in your P&L you're having a profit of 200 naira, it shows that that company has problem. That means that profit is just a paper profit. It shows that that profit does not have quality. Because if it does, it should be backed up by appropriate cash flows from operations. From operations. That's the first thing. Another one is that by the time you look at movements within the operating activities, because operating activity will show you movement in your receivables, movement in your payables, movement in your inventory. It shows a lot. When you see a company having an increased receivables, increased payables, increased inventory, if all of these items are increasing speedily, it might be an indication of overtrading or overcapitalization. And also, when you see a company having excessive increase in payables, it might be an indication that this company is having liquidity problem.
It might indicate that this company cannot fund or pay back its suppliers. It is delaying its suppliers' payments just so that it can use that money to fund its operations. So operating activity speaks a lot about the well-being, about the financial health, about the profit quality, about the short-term liquidity of a company. When you now go to investing activities, that's when you will now see the movement within their long-term assets. And when you see a company that is selling its assets, I mean, you need to ask, why are they selling their assets? What are they using it to do? Are they shutting down? What asset are they selling? And if they are selling asset and replacing it with another, fine. But when they are selling off assets, when you see selling of assets here to fund short-term liquidity requirements, it shows that the position is significantly lower or weak. And when the companies is selling their non-current assets, their long-term assets, it means what would they then, if they want to borrow money from bank, what would they use to stand as collateral? Okay, all these indicates can show you the strength or weakness of a company, or their even ability to continue to operate as a going concern. And a lot of other items that you can see, like whether they have dividend received or interest received. I mean, that will show that, okay, does this company has sufficient passive income or recurring cash flows arising from the investment they hold. Investing activities will run you down all of these things. And financing. Of course, this would quickly show you the risk this entity is exposed to. You see it. Financing activity will show you the differences between last year and this year, will show you exactly how much money they have raised in terms of shares, equity, or debt. It will show you. It will show you the finance costs, the interest they are paying. It will show you in cash. And you can clearly see and compare this with their cash from operations. I mean, by the time you take away cash from operations or finance costs from cash up from operations, you have an idea of what is remaining for other activities. It should be big. The difference should be wide for any company, as it were. Okay, so that is it. That's the rundown of ratio analysis. Now let's go to past questions. Before I go to past question, do we have any questions before I move to past questions? Starting from last direct question. I need somebody to read this question for us, please.
Okay. Question one. Alpha PLC is an entity which has grown in recent years by acquiring established businesses. Alpha PLC is contemplating acquiring Beta Limited and Gamma Limited. So Alpha PLC, Beta Limited, and Gamma Limited operate in the same industry. Alpha PLC believes that their company shareholders will be receptive to the takeover. The management of Alpha PLC has indicated a total that is 100% acquisition price of 12 million naira for each of the companies. Yeah, so this is the financial statement for Beta and Gamma, showing the statement of profit or loss for the ended. Okay, so yeah, okay. So the following ratios have been calculated. They've calculated gross profit margin, return on capital employed, current ratio, asset tax ratio. All right, so required, write a memo to the director of Alpha PLC, advising him on how to make investment decisions, considering the performance and the financial position of Beta Limited and Gamma Limited for the year ended September 30, 2020. That's 14 marks. Then B, what other qualitative factors should the management of Alpha PLC take into consideration?
All right, thank you. Okay. I think he hasn't, okay. I think he lost his audio or something like that, but he has finished reading everything. Okay. So
Yeah,
thank you,
okay, my next
Jacob.
one went.
Yes, I figured. So thank you. Okay. So this was that question. And firstly, like I've told you before now, I like you to read the requirement of the question first before you even go to the body of this question. So, and when you look at this question, the examiner wants us to write a memo to the director of Alpha, advising him on how to make investment decision, considering the performance and position of Beta and Gamma for the year ended September 2020. And it's 14 marks. So can anybody help me multiply 14 times 1.8? What would that give us? What's 14 times 1.8?
It's 5.2.
Sorry?
25.2.
25.2. Okay, so that means we have approximately 25 minutes for this particular question, right? 25 minutes for you to write a memo to advise the director on how to make investment decision, considering performance and position of Beta. Okay, so I mean, on how to make investment decision, considering performance and position. So how do you want to approach a question like this? So I will leave that. B talks about what other qualitative factors should the management of Alpha be considering, assuming Gamma is a foreign subsidiary, which is also another 6 marks. So approximately I'll be having around 30-something minutes to fight for my life, 20 marks, knowing fully well that I need around minimum of 15 marks from here, and I have around 35 minutes. That's a very short period of time to do this. So I can then go to this question, carefully understanding the context, right? So for you guys, your ratio is not just calculating ratio. It's very little about, I mean, in the last 2 years, I'm not sure they have asked you to calculate ratios. They have not really asked you to calculate. They will give you the ratios. They will ask you to advise, analyze, interpret. That's what you find. So first thing is that you need to understand the context within which they want you to do this analysis. You need to get that context right first. So this particular one, the context there is quite straightforward, because what is happening is that Alpha wants to buy these two companies. So, and each of them is 12 million naira each. And that was it. So, I mean, they're not asking you to advise them on that investment decision. So should they buy, should they not buy? Considering the performance and position of each of these companies. So it's either you advise them to buy the two, or to buy the one, or to buy one of them. Okay. I mean, they were not specific. They just say, okay, give them investment decision. That's the context here. Alpha wants to buy a company or two companies. So they gave us performance statements of the companies, position statements, and they gave us an additional information. I mean, the key thing here is the fact that, okay, grant was deducted. You might need it, you might not need it, pending. And also, they have already given us some ratios, a lot of ratios. So, investment decision. Now, how do we do well in a question like this? The first thing is that when they say write a memo, write a memo. If you look at the way I started, I said from the accountant to the director. And I didn't just make up this director. They told me that it's to the director. And the subject is exactly what the question wants me to do. How to make investment decision considering the performance and position of Beta Limited and Gamma Limited for the year ended September 30th, 2020. And the date, I just wrote the dates that they asked me to write. I mean, the date of the financial statement, which is September 30th, 2020. So, I mean, that structure has opened me up for a few marks, maybe 1 mark. Then I start with an introduction. You can introduce however you want to, if you have more detailed information. But I mean, I just want to introduce like, okay, the subject matter refers. The following paragraph examines the financial statement of Beta Limited and Gamma Limited using ratio analysis with a view to providing advice on how to make investment decision considering the performance and position of Beta and Gamma Limited. That's one. So, I mean, when I do my introduction, then I can see that they gave me ratios of each of them. Right? So if they are giving me the ratios of each of them, then why are they giving me their financial statement again? That means I'll just look at it and compare very fast their financial statement for each. Because ordinarily, they will give you ratio and not give you financial statement. But now they give me. So when you look at Gamma, revenue of Gamma is higher than revenue of Beta, which trickle down to gross profits. In fact, cost of sales of Gamma is higher than, but ultimately, Beta has higher profitability. Ultimately, in the end, I mean, it was able to make more profit. Also, when I glanced through their position, I saw that non-current asset of Gamma is almost ×2, over ×2 of that of Beta, and the relative total assets is higher, even their capital too, of Gamma. So, I mean, I know immediately that Gamma is a bigger company in terms of, even though from looking at this absolute profit, you find out that this guy seems to be more profitable. So that will form the basis of my next paragraph. I said that the absolute figures of revenue and assets of Gamma Limited shows that it is a bigger company than Beta because performance and position are larger in absolute terms than that of Beta. And I said, in order to make investment decisions, there is need to compare the revenue and profits to the resources that generated them, so as to ascertain the efficiency and profitability as well as liquidity position of the two companies. So immediately, I already debunked what the examiner was trying to show me, that, okay, that will I make judgment or investment decision looking at the absolute figures alone? I already told the guy that, okay, I understand ratio very well, that I'm not going to base my judgment on the absolute figures. I'm going to look at the underlying resources that generated each of these items, revenue and profits, but for me to then judge and say, okay, which is better? Okay, so then, having mentioned that, I can then move to the ratios. all of these ratios. So ultimately, you within that 20-something minutes you have, you must stock on each of them, all of them, almost all of them. So, but I now categorize it because I know categories of ratio. I start with profitability ratio. And the king of profitability ratio is ROCE. And this is how I always recommend my students to analyze. Keep it simple. Keep it simple. If you don't have enough details, just keep it simple. I said the ROCE of beta is 62.5%, while that of gamma is 31.1%. This shows that beta makes more profit from its underlying financial resources. And of course, this is what I'm talking about. This ROCE here. Where is it? This one. From here. Right? Then I move to gross profit margin. I said the gross profit margin of beta is 24%, while that of gamma is 18%. This shows that beta makes more gross profit on every 1 naira of sales. You will see that as I'm expressing each of them, each of their ratio, I'm telling the examiner what they mean. I'm telling the examiner that what it shows for beta to have an higher ratio. So this guy knows that, okay, you know what you're talking about. This shows that beta makes more gross profit on every 1 naira of sales. That is what the ratio shows. Profit margin. And all this ratio, I'm not generating it though. It's what the examiner gave me. They gave me ROCE. They gave me gross profit margin. They gave me profit margin. They gave me everything. So I'm not thinking. I'm just dubbing. Then, profit margin. They say the profit margin of beta is 19%. Gamma is 12.3%. It shows that beta makes more profit on every 1 naira of sales. It's still the same thing. Then I go to efficiency. Again, the examiner gave me a closing inventory holding period. I told him that this ratio, the inventory holding period of beta is 31 days. Gamma is also 31 days. Abi? Okay. Holding period for gamma is 38 days, not 31 days. And the lower the better for holding period. So this shows that beta is more efficient in selling its inventory to customers. Then net asset turnover. I said the net asset turnover of beta is 3.3 times, gamma is 2.4 times, 2.5 times. It shows that beta is more efficient in converting its assets to sales, because that's what net asset turnover means. Then trade receivables collection period. I told the examiner that the trade receivable collection period of beta is 31 days, gamma is 47 days. It shows that beta is more efficient in the collection of outstanding from customers. Then I go to payables period. I said payable period of beta is 24 days, gamma is 23 days. This shows that beta gets more days from its supplier because of its creditworthiness, right? I didn't say that he's getting more days because he will be able to use that money to reinvest it. No, I don't. That argument is not supported. Then I moved to liquidity ratio. Then I said, I picked my current ratio. Current ratio of beta is 2.4 to 1. Gamma is this. It shows that beta has highly short-term assets to settle is. I moved to acid test ratio. I moved to stability ratio, like that. And the pattern of my analysis, I'm just showing the examiner that I understand what I'm talking about. So for the Gini ratio now, you see the Gini ratio of beta was 65.8%. Gamma was 64.6%. I said this shows that beta has more depth in its capital structure. But since the ratio is less than 100%, it shows they are both appropriately geared. Okay, because I first checked how did they even compute this ratio self so that I will know whether it's 50% or 100%. I saw that okay, this guy has debts, and I went to check the equity. I saw the equity is equity is 2.6, and this one plus this one. This is above 100%. Why this one? I need to correct distance. I didn't check it very well. Because apparently they used debt over debt plus equity to get this their ratio. So both of them are highly geared. That's what it means. But my conclusion, I said, then following from the ratios computed above, Beta is a superior company. Beta is superior from the standpoint of profitability, liquidity, and efficiency. And I said, though Gamma Limited is also a viable company because it's doing well. But at this point, I will advise Alpha Limited to acquire Beta Limited or the two companies if they have the available financial resources. And that's that for that question, which is the 14 marks part. Then the other parts where they wanted us to identify other qualitative factors. Other qualitative factors the management should take into consideration, assuming Gamma is a foreign subsidiary. So, which other qualitative factors do you think you will have considered that will have given you 8 marks? Assuming this guy is. So I will consider the regulatory framework. Regulatory framework in the country where Gamma is situated. I will look at the economic policies and relative stability of the business environment where it's located. I mean, that's really this, let me call it macroeconomic policy, so that I won't be babbling around each of them. Okay, for that, then I want to consider probably the corporate governance system, the corporate governance structure of the company. Other qualitative factors, I would probably consider their sustainability reporting policy. I would even want to consider their organizational culture. I would consider which one again? Nobody is helping me. Okay, market and competitive landscape. What does that mean? But I'll write it. They
You
give
can
them
look,
English and
mm,
they won't understand.
you can look at the level of competition that the company has within that country it operates. If there
Okay.
is high competition, I think you can meet up with competition. You can also consider that while trying to acquire
Oh,
the new
fantastic.
company.
Fantastic, fantastic, fantastic. Okay. So what other things can we look at? I
I would
need,
say culture.
it is there already.
Okay.
Organizational culture is there.
I'm talking about like in terms of demand culture, the people, not just the organization. Like the
Okay.
markets.
Okay. So the demand pattern,
Yes.
customers in a country. Okay. That's also
Yeah, I think
um
if you look at the public image,
of whom now.
that's of the company itself.
Yeah, well, that can work. I also look at their risk management policies. I mean, there are a lot qualitative factors that you can look at just beyond the numbers. You need to look at, I mean, you can also look at the people behind the company, the caliber of directors they have, the caliber of shareholders they have, their employee relationship, their policies on CSR, their relationship with government and their society. I mean, these are a lot of things you can look at when you want to buy a company, beyond just looking at profitability, liquidity, and solvency. It's beyond that. Okay, so I mean, that last diet question was quite interesting, that I would expect most students should do well because there was no serious context. This was easier than the one they asked in November 2023. This is a much easier, it's very straightforward. It's a very straightforward ratio. Okay, let's go to that November 2023.
Sorry, I want to ask a question.
Please ask.
So this question that we solved now, that we attempted now, there was a part where they added additional information. So is it that there was no use for it? Because I'm finding it difficult to believe that I cannot actually set the question that is this straightforward. Because seeing the additional information, I would have thought that, oh, I would need to calculate something somewhere or change one of the ratios.
Yes, so that's always the challenge. So it's not all information they give you that you have to use. If you see any use for it, use it. So I mean, I've just solved it in a way that I would have expected a normal student to solve it in the exam, keeping it simple. If I had use for them, I would have probably used it if I want to, right? And example of places you can actually talk about this is when we were talking about ROCE, for example. Now, ROCE. I could say that the reason why this guy had an higher ROCE was because his underlying asset was lower. Okay. His underlying asset was lower because some of his assets were funded by government grants. Right, which is why he's having an higher receipt. So that gave him an advantage. But because Gamma has huge assets, it's worked against him when we put it on profits like that. So you could speak on that, then you move on from there. But you won't really have to start calculating something big, considering that you have to even come up with this. Yes, it might look as if it is straightforward. No, it's not. It will take you minutes in the exam for you to even come up with something this good that will have earned you almost all the marks, if any. So, but if you think you can actually cover that, you can look at it and quickly figure, then fine. It's okay. Right? But with this, you are also still fine. But good question anyways. So let's look at this one was a more technical one, the one of November 2023. Yeah, Jacob, read.
Mama Kitchen PLC owns a number of subsidiaries that operate standard fast food eateries in all the 6 geopolitical zones of the country. You are the financial analyst of your bank, Pam Pam Bank Nigeria Limited, which owns 10% of the issued share capital of Mama Kitchen PLC. So you are provided with the following financial and background information on Mama Kitchen PLC. So this is the statement of profit and loss for the year ended September 20. Okay. Okay, so statement of cash flow also. Okay, so background information. One, Mama Kitchen PLC has a reputation of depreciating its assets more slowly than others in the industry. So the strategy of the group is to fund new fast food outlets capital expenditure from existing operating cash flows without the need to raise new borrowings. Three, the revenue growth in the industry is estimated at 4.1% per annum. Four, it is the company's policy to increase promotional and advertising spending on new outlets to encourage strong initial sales. Okay. 5, the board has accused the management of concentrating on new outlet openings to the detriment of existing outlets. 6, one of your colleagues, a financial analyst, on going through the consolidated financial statements of Mama Kitchen PLC, has stated that the company has not been able to pay dividends because of the debit balance on its consolidated retained earnings. So required, A, draft a report addressed to the managing director of Pam Pam Bank Limited, analyzing the profitability, cash flows, and investor ratios of Mama Kitchen PLC. You should also identify and justify matters that you consider will require further investigations. B, explain the validity or otherwise of your colleague financial analyst statements that Mama Kitchen PLC was unable to pay dividends because of the debit balance on consolidated retained earnings. C, explain the usefulness and limitations of diluted earnings per share information to investors.
Okay, so this was a more technical question than that last diet one. So, of course, almost the same direction because they want us to draft a report addressed to the managing director of Pam Pam Bank. And they want us to analyze profitability, the cash flows, and investors' ratios of Mama Kitchen PLC. And you should also identify and justify matters that you consider will require further investigation for 13 marks. So that was around 22 minutes or thereabout for you to quickly get 13 marks from here. And I think one of our colleagues made a statement that they say we should explain the validity of that statement. That was saying that Mama Kitchen was unable to pay dividend because the debit balance on the consolidated retained earnings, and that was for 4 marks. And they want us to explain usefulness and limitations of diluted earnings per share to investors. I mean, this is a very strong question. So they want me to draft a report. So of course, you need to make your you need to make your solution in a report format, just like form to subject dates. But I'll come to that. I'll want to look at the question. When it comes to question on ratio, again, I want to get a context. Within what context are we talking about? So I will quickly want to identify that. And from here again, I can see that Mama Kitchen in this instance now that we're analyzing in this question is we already own 10% of Mama Kitchen. We already own 10% of it. So why are they now asking us to analyze it? No particular reason. They shall want us to analyze it. No problem. So it's not like we want to acquire more. I mean, maybe he has the intention, but it's not stated here anyways. So they gave me the consolidated P&L of Mama Kitchen. Of course, since it has a number of subsidiaries, they gave me consolidated statement of cash flows. I mean, that analysis of cash flows I explained to you will be helpful here. They also told me that details of revenue, fast food outlet, and new fast food opening for the year ended. So revenue per fast food open in the current year, gross profits, September current year. Notes 30 new outlets were opened during the year to bring the total to 115. Okay. So they gave me some ratios. They now gave me additional background information. They said Mama Kitchen has a reputation of depreciating its assets more slowly than others in the industry. That's an information. Number two, they said the strategy of the group is to fund new fast food outlets, capital expenditure from existing operating cash flows without need to raise new borrowings. Okay. They also said revenue growth in the industry is estimated at 4.1%. Okay, revenue growth in the industry. Okay. It says it is company policy to increase promotional and advertising spending on new outlets to encourage strong initial sales. They said the board has accused the management of concentrating on new outlet opening to the detriment of existing outlets. They also said one of your colleagues, a financial analyst, on going through the consolidated financial statement of Mama Kitchen, has stated that the company has not been able to pay dividend because of the, okay, that was one they were asking question on. Okay, so how do we analyze this? Again, keep it simple. I mean, just move step, don't overthink anything, otherwise you will not do anything for 1 hour. When you're thinking that it should be difficult, it cannot be easy. No. Keep it simple. So write your formats. They said you are the financial analyst, is mentioned in the question. You are writing it to the managing director, and the subject is analysis of profitability, cash flows, and investors' ratios of Mama Kitchen. I didn't think I got it from here, from the question, because that's what they want me to do. Then I make that the subject. And the date I used was the date of the financial statement. Then my intro, I said the subject matter refers. The following paragraphs analyze the profitability, cash flows, and investors' ratios of Mama Kitchen. Okay, and I can see that they gave me 2 years. So since I was given 2 years, I then start with the profitability. So profitability, mostly I'm used to starting with ROCE, because ROCE is the most important measure of profitability. And they already gave me the ratios. Nobody's asking me to compute anything. The ratio was given. So, and this is how I analyzed it. I told them the ROCE of Mama Kitchen improved from 19.1% in 2022 to 20% in 2023. But now I explained further because of all this background information they gave me. I would refer you to it now. They said these improvements can be partly attributed to a strong revenue growth of 29.5%. This is where I compare to industry average revenue growth rate of 4.1%. You see, why I'm speaking to that is because the examiner gave me that the revenue growth of the industry is 4.1%. So I need to speak to this, but they're giving me a context. And I checked the revenue growth of Mama Kitchen. If I check the increase in this, and the way I got is this minus this, whatever you get, divided by the base to give you that ratio. So it's partly due to this. I didn't attribute it fully to it. It's partly. And I say furthermore, considering that the company depreciates its assets slowly, it will be expected that the higher asset position will negatively impact on its ROCE. But the reverse is the case. Because I also intentionally mentioned that because they gave me a context that Mama Kitchen has a reputation of depreciating its assets slowly. You know, when depreciation is small, your carrying amount will become higher, which would mean that the denominator of your ROCE is big. That would make your ROCE to fall. But here now, the reverse was the case. So this company is doing very well. So I've already used this one. At least I've mentioned it and I've related it to my case. And I've also related this to my case as well. Then I move to the next ratio. The question gave me, so it's not like I'm the one coming up with these ratios. And even if they don't give me, you can actually come up with them because you should know them. But since they gave me, I just restricted it to what they gave me. So the gross profit margin improved marginally from 24.3% in 2022 to 25% in 2023. This is also an indicator of strong revenue growth and good cost management, right? I just related it to that. I can't attach it to, I can only attach growth in gross profit margin to revenue growth and the fact that they manage their cost. And I said, additionally, the earnings before interest, tax, depreciation, and amortization of 31.3 in 2023, I'm talking about these that they gave us. These earnings before interest, tax, depreciation, before they remove all of these items, it was this. Told them that amount is higher and very close to the net cash flows from operating activities. I even need to write the amount of how much was it? Net cash flows from operating activities, 28.6. 28.6. So you see that this guy, I said, this is an indication of a good quality profit that is backed up by appropriate cash flows. Because he has profit of 31.3, right? And his cash flows is 28.6. They are close. That means this profit is not just about paper profit. It's backed up by appropriate cash flow. That is even before they remove depreciation and amortization. Oh. That means if they remove all of these depreciation, amortization, interest, the profit becomes lower and the profit from operation will be higher, which is good. It's a good quality profit that is backed up by appropriate cash flows. It's good. Then I went to non-current asset turnover. I said this ratio improved from 1.49 times to 1.68 times in 2022. I said that this can be attributed to the revenue growth resulting from opening 30 new fast food outlets. I have to bring in that. I mean, that is how you bring in context to your ratio. So for them to be selling, because net non-current asset turnover is a measure of quantity of sales, is a measure of how big your revenue is relative to your non-current asset. So it's improving. It improved from 1.49 times to 1.68. So I just linked it to the fact that they opened 30 new, and this is where I got it from the correction. They told me that notes 30 new outlets were opened during the year. To bring the total to one, I just bring in that for my non-current asset turnover. All of these are what will earn you good marks. And don't forget, you don't have time. This is just a 13 marks question that you would rather have like around 22 or 23 minutes to solve. So you need to be sharp with your thinking and be moving. Then I move to cash flow. I'm done with profitability. I move to cash flow. In the question, they gave me current ratio. I told them that the current ratio improved. I mean, the fact that you are saying it improved, it shows that you understand the ratio itself, because you know that the higher, the better. It improved from 0.48 ratio 1 to 0.56 ratio 1 in 2022. And I said, though the current ratio is improving, but it is not high enough. It's not high enough because at least it should be 2 to 1. So it is not enough. And I said, this can be attributed to the company's strategy of funding new fast food outlet capital expenditure from existing operating cash flows and the yield of every promotional and advertising expenses. What does that mean? First, let me attend to this one. This is what I'm referring to. They said the strategy of the group is to fund new fast food outlet capital expenditure from existing operating cash flows without the need to raise. So they are funding capital expenditure from their operating cash flow. So that is affecting their liquidity. That is affecting their current ratio. Okay. So I had to link into it that, yeah, it's improved marginally, but it's not high enough. And this is because of their strategy. And also, and the heavy promotional and advertising expenses that they are doing. It's really hitting them hard on their current ratio. So I linked you to that. So the question also gave me cash return to capital employed. I told them this is improved. And I said this is attributed to the strong operating cash flow position in both years that we have from the statement of cash flows. Then I moved to investors ratios. The only investors ratio they gave us in the question was they gave us share price. What did they give us again? Yes, earning per share. I used the basic earnings per share. So they gave us earnings per share. So I told them that this ratio improved from 21.3 to 26.8. This indicates an improvement in the profitability of the company. Then I talked about even though they didn't give us any yield, but since I have earnings per share and it gave me market price, so I can compute earnings yield. So is it earnings yield? This is not earnings yield though. This is price earning ratio. Abi? Yeah, I can compute earnings yield. Earnings yield. But this interpretation, It's not correct. Yeah. So earnings yield, so improvement in shareholders. This improvement shows increased investors' returns, and you can also do price earnings ratio too to see, since they gave us those information. So I can say the PE ratio in 2022, the PE ratio in 2022 was, so PE ratio is price over earnings. So can anybody press calculator? This is where I got the price from in 2022. They gave us an equation, 290 kobo. And the earnings is 21.3 kobo. So it's given, just dubbing from the question. So anybody calculator, 290 over 21.3.
$13.62.
13.62. Okay. While in 2023, it is that's 302 divided by 26.8. So how much is that?
$11.27.
11.27. So it's declining. How is it declining? This decline shows, this decline shows a reduced investors' confidence in the company. It's doing well now. Anyway, that's what the ratio is showing. There's nothing we can do. Okay. So they also said you should identify and justify matters that you consider require further investigation. Did we observe anything that will require the few ones? I just interpreted that also as some qualitative factors and some other breakdown of their assets, receivables, and all of that for me to understand their situation better. So I talked about the following areas requires further investigation, their capital expenditure register, their aging schedule, do they have good corporate governance in place, their organizational culture, the breakdown of potential ordinary shares. And why I'm asking this is because I saw that they gave us diluted EPS. So let's have the breakdown of potential ordinary shares so that we'll be sure that we will know when they would actually become ordinary shares, and some other points you might also raise. And I said, following from the ratios computed, we can conclude that Mama Kitchen Limited is a strong company from the side of profitability, liquidity, and investors ratio. Thank you. Then you write your name. And probably sign. Then you move to the second question. Okay. For 13 marks. Then the second question is explain the validity of your colleagues' financial analyst statements that Mama Kitchen PLC was unable to pay dividend because of the debit balance on the consolidated retained earnings. Okay, so in order not to waste our time has gone. The way you respond to this, you get 4 marks from here is you tell them that dividend is paid based on individual entities, performance, not on consolidated performance. So to assess whether Mama Kitchen can pay dividend, so they will look at the earnings of each of the subsidiaries and itself. Do we have sufficient earnings from which you can pay dividend? Then if we can, then they can go ahead and pay. So that statement is misleading and is inaccurate. So that's that for that. Then they say we should explain the usefulness and limitation of diluted EPS. So I know that you have done diluted EPS, and you know that diluted EPS would show the effect on EPS when some potential ordinary shares become ordinary shares. So you'll find out that your diluted EPS will always be lower than your basic, because that will have considered those that would become ordinary shares in the future. So one of the usefulness of diluted EPS is that it's very useful to investors. It's very useful to investors because it helps them to know what their future earnings would be. What their future earnings would be if the potential ordinary shares, if they become ordinary shares. So it's useful to the investors. It is also useful to the company itself because it shows them how hard they need to work to improve their earnings in order to sustain the same level or even an increased level of earnings to existing shareholders. It makes them plan in advance. But the limitation of this diluted EPS is the fact that it usually assumes that all the potential ordinary shares will crystallize at the same time, whereas it's not always like that. All of them will not crystallize at the same time. That's a big limitation for it. So what it's calculating is inaccurate. And secondly is that it uses current year earnings to judge future ordinary shares, whereas the earnings of the company might have either increased or decreased, as the case may be. It's a limitation, so it's inaccurate because they are using current year earnings on future ordinary shares. Okay, so at least 3 marks. Make sure you make 3 good points for the examiner to give you good marks from that. And that's that for that diet. You can build up on this, but if you're able to do this in the exam, you will have done well for yourself. So this is May 2022. There is you can check November. This is November 2023. You can check May 2023. Is very similar to this. There is November 2022. This is November 2022. So this diet, they asked us to compute. Yes, this one, they said assess the relative performance of the two companies with 3 suitable ratios. So they wanted us to compute 3 ratio here, 3 ratio here. So we'll see trade payables turnover period like that. Just if you can try this, then when you compute it, you then analyze it. You write a report to analyze. You see that this one takes to this diet was even much more easier. So you can take whatever format. So I will leave you to it to practice all of this. This is another one. This was that they were asking limitations of financial statements, right? After asking you to analyze ratios and all of that. So yes, and this was that they were asking, what does quality of earnings connote? And I've already told you today the meaning of quality of earnings. Where your operating cash flows and your profits in the statement of profit or loss are very close. When they are close, it shows that the profits that you're presenting is actually backed up by appropriate cash flows. So do you have any questions? Any questions? Okay, so I'm going to draw the curtain here tonight. So next week, we are going to be looking at, like I've promised, disclosure of non-financial information. I'll look at that along with ethics. So last day, they didn't ask any of those ones. So of course, they will ask it this diet. There is 90% chance that you will definitely see it in the exam. So hopefully we'll be able to cover that. Then that will not be our last class. We are still going to have another class where we are going to look at operating segments and interim financial reports. And then maybe after that, we can then say, okay, we're not having any class again. Or maybe we want to have revision, whatever. But so I'll see you guys next week. Thank you. Have a wonderful night.